So now let's proceed. Now in our last session, we looked at taxation of real estates or property development entities. Now let's look at transfer of property. We are still using the same document. I'd already shared it again. Transfer of property. And what do we mean by transfer? So now, property means either, number one, land situated in Kenya. Number two, any right or interest in or over the land. Also, a marketable security situated in Kenya. Also include property acquired or held for investment purposes. Also for the companies, all forms of assets. That's what we call a property. Property does not necessarily just mean land or building. It also means any other asset. That means your property. Now, when we say that there is a transfer of property, when we say there is a transfer of property. Now, there is a transfer of property if, number one, where the property is sold, exchanged, or conveyed, or otherwise disposed of in any manner, including by way of gift, whether or not for a consideration. Number B, in an occasion of loss, destruction, or extinction of property, whether or some of a way of compensation or otherwise, under the policy of insurance is received. Yeah, for example, if your asset was involved in an accident, it was written off and then you are compensated by the insurance. So it will be considered as a transfer because you have now been compensated. Then number C, on the abandonment or surrender or cancellation or forfeiture. Yeah, mostly the forfeiture happens for the shares or forfeiture of or compensation or substantially all the rights to the property. Yeah, that's when we say that there is a transfer. Now, what are some of the examples of transaction that are not deemed to be transfer? Now, for example, if you use your title as a security to take a loan from the bank. Yeah, use it as a security. Does it mean that you have transferred them? Eh? So that one is not a transfer. So let's look at transactions which are not deemed to be transferred. Number one, transfer of property merely to secure a loan or a debt. Number two, transfer by creditors only to return property used to secure a debt. Also, transfer for the purpose of vesting in a personal representative or a deceased person. Yeah, for example, in case of a deceased person, yeah, maybe when one party dies, and then in this case, the property are not yet transferred. You know, you act like a trustee for those property. Let's assume it's the wife. Now, that one does not mean that now you have transferred, provided all the property are under the name of the deceased. So that one is not a transfer. For it to be transferred, you must change the name from the deceased person to your own name. That's when you deemed to be a transfer. Then also number four, issuance by the company of its own share. Yeah, when a company buys its own share, there is no way you can transfer that property from your name to your name again. So in that case, they are not deemed to be a transfer. Also transfer of property through the vesting in a liquidator or official receiver or trustee in a divorce settlement. Good. Now let's look at capital gain tax. I will say that when you transfer property or when you sell an asset at a gain, that gain is not taxed because they have a special provision at the rate of, or they'll be taxed at a specific tax known as the capital gain. Now, capital gain used to be at 5%, but now the rate has changed effectively from February, 1st of February 2023. Now, instead of 5%, Now the capital gain tax will be how much? 15%, correct. So in that document, you need to change everything. It's only the tax rate will change. Now it will be at the rate of 15%. So now let's discuss that capital gain tax. This is a tax chargeable on the whole of gain, which accrues to a company or an individual on or before the 1st of January 2015. And that's when it was introduced, capital gain tax in Kenya, on the transfer of property situated in Kenya, whether or not the property was acquired before 1st of January 2015. The rate is 15%, not 5. Can you add 1? So now it should be 15%. Now, the rate is 15% of the net gain. Can you add net gain? Yeah, is at the rate of 15% of the net gain, not gross, but of the net gain. And how do we get that net gain? Now, get the net gain, you'll take the transfer value, you raise all the adjusted costs. Now, what you get now as the net gain, then you charge at the rate of 15% of that net gain. Now, when should you file or when should you remit this tax? It's like a VAT. Should be paid on or before 20th of the month following that of transfer. That's when you should remit the capital gain tax. So I think that the rate is 15% of the net tax, and it's a final tax and cannot be offset against other income. So in short, it's a specified sources of income, cannot be offset against other income. The tax is payable upon the transfer of property, but not later than 20th day of the month following that which the transfer was made. Now, the tax is paid by the person, either a resident or non-resident, transferring the property. And then the net gain is the excess of the transfer value over the adjusted cost of the property that has been transferred. I was trying to explain this. Yeah, the net gain is the transfer value, you minus the adjusted cost. The transfer value is the amount or value of consideration or compensation for the transfer of property, less incidental costs such as transfer cost. Now, the following document will be required. Number 1, computed capital gain tax from a form by the seller. Also, a copy of the sale or transfer agreement of the property. Also, evidence of the incidental cost related to the acquisition and transfer of the property. Also, a report from the registered valuer of the property. You need to have the valuation report of the transaction between the related party, and then any other document or information that the company might require. Good. So let's do that question. November 2015, question 4B. November 2015, question 4B. Mjengo Limited is in real estate business. And during the year ended that 1st of December 2014, the company acquired 10 houses each at 4 million before incurring the following expenses. So they acquired 10 houses each at 4 million before incurring the following expenses. Yeah. So that's what you call the incidental cost. 10% interest on mortgage loan, 10 million. Conveyance fee for each house, 40,000. Now, conveyance fee is the cost incurred when transferring the ownership. Also, estate agent valuation fee per house, 28,000. Repair undertaken for 2 houses, 44,000. Cost of repainting the houses, 84,000. The impairment loss of the houses was estimated at 150,000. Legal expenses amounting to that 6 were incurred in defending a title for the house with the defective ownership document. Mjengo Limited sold each house at 5.8. Now that's the selling price. Huh? The cost for advertising the house was 160. Estate agent commission 180. Insurance 72. Valuation fee 150. And legal fees was 148. Required, determine the following. Number 1, transfer value. So how do we get the transfer value? Now to get the transfer value, you take the gross or the selling price or gross transfer value. Remember we had bought 10 houses. Then each was sold at how much? Yeah, each at 5.8 each and were 10 houses. So how much was the total revenue? Should be 58,000. Then you raise incidental cost of selling. Incidental cost of selling. They told that Mjengo Limited sold each house at 5.8. The cost for advertising the house was 160. So we incurred advertising cost. Advertisement cost, an amount of 160. Also, estate agent commission 180. Agent commission amount of 180. Also, there was insurance 72. Also, valuation fee amount of 150. Also incurred legal fees amount of 148. So now give me the total incidental cost of selling. We have 70. Good. So now give me the net transfer value. Number 2 of the question. Adjusted cost. So how do we get the adjusted cost? Now to get the adjusted cost, you take the purchase cost. Purchase cost. How much was the purchase price per house? Yeah. So the company acquired 10 houses, each at 4 million before incurring the foreign expenses. So it's 4 million each house that bought 10 houses. So the total was 40 million. Then you add incidental cost. This is what you incurred to purchase. Before incurring the foreign expense, you had also incurred other expenses. 10% interest on mortgage loan of 10 million. So there is interest on loan. 10% of 10 million. You get an amount of 1,000. Conveyance fee for each house, 40,000. We incurred conveyance fee, 40,000 per house. So you multiply by the number of houses, 10. So that's 400,000. Estate agent valuation fee. There was valuation fee per house, 28. So 28, there were 10 houses. So incurred a total of 280. Repair undertaken for 2 houses. Repair cost. An amount of 44. That one is don't multiply by 2 because we are told that The repair undertaken for the two houses, 44. You are not told each. So that means the total cost incurred. Then there was cost of repainting the house. Repainting cost. And they incurred an amount of 84. The impairment loss of the houses was estimated at 150. That's not an actual outflow. Then legal expenses amounting to that 6 were incurred in defending the title for the house with the defective ownership. So that cost is a legal cost. It was incurred in the process of securing the title. So legal cost. They incurred an amount of that. Now give me the adjusted cost. Sorry? This one we are adding the incidental cost. We are not deducting. What one? 844. 844. So that means how much will be your capital gain? So to get the capital gain, you'll take the net transfer value, you deduct the adjusted cost. Our net transfer value was an amount of 57 to 90. Then you raise the adjusted cost, an amount of 41, 844. What do you get? Sorry? 4 points. Number 3, capital gain tax. So let's get the capital gain tax. Now to get the capital gain tax, you take 15% of 15,446. Sorry? 23? Like that, eh? Number 4, the due date for filing the capital gain tax. Due date. On or before 20th of the month following the month of transfer. Following the month of transfer. Good. So I want you to adjust to your notes. You want to change the rate, eh? Now instead of 5%, now should be 15%. Doing that. November 2017, question 5A. November 2017, question 5A. You are told that Mawera Properties Developers Limited purchased a residential house on 1st of January 2015 through a 12% per annum mortgage loan of 4 million. The company incurred the following expenses in obtaining the loan: audit fees, 48,400. Valuation of the houses, 120,000. Legal fees for conveyance, 80,000. Additional information. The company placed all the doors in the residential house with a metallic door at a cost of 96,000. On that 1st of December 2016, the company sold the house at a price of 8 million after incurring the following expenses. Those are what we call the incidental cost of selling: repair of the houses, advertisement, agent commission, valuation fees, as well as the legal fees. Required: compute the capital gain or loss arising from the sale of the above house. Determine the capital gain or loss. So to get the capital gain, so determination of capital gain. So we start by determining the transfer value. So start with the gross transfer value. And we are told that, note number 2, on that 1st of December 2016, that's after 2 years, the company sold the houses at a price of 8 million after incurring the following expense. So 8 million after incurring the following cost. So you raise incidental cost of selling. That's what you call the cost of sales. The cost incurred in the process of generating that 8 million. Number 1, there was repair of the house. So repair cost, amount of 78. Also advertisement. Advertisement cost an amount of 24.2. Agent commission. Amount of 12. Valuation fees. Amount of 148. As well as there was legal fees. Amount of 42.8. So now give me the net transfer value. Get an amount of 76.90. Then we raise the adjusted cost. So how do we determine the adjusted cost? So the first paragraph you told that Mawera Properties Developers Limited purchased a residential house on 1st of January 2015 through a 12% per annum mortgage loan of 4 million. That was the purchase cost. Purchase cost incurred an amount of 4 million, but this was a loan. Then you add incidental cost. This was a mortgage. So they acquired on 1st of January 2015 through a 12% per annum mortgage loan of 4 million. So you need to factor in the interest on loan. So you take 12%, you multiply by 4 million. Then that loan was for how many years? You're not told. Yeah, they disposed on note number 2. On that 1st December 2015, the company sold the house. So after how many years? 2. We just work with the 2 years. We multiply by 2. You get 960. Then you're told that the company incurred the following expenses in obtaining the loan. There was also audit fees, an amount of 120. They are known as the borrowing cost, and the borrowing costs need to be capitalized. Then we have valuation of the houses. So valuation fee incurred was also an amount of, sorry, this was, audit fee was 48.4. This is 120. Then legal fees for conveyance. Yeah, conveyance fee. Amount of 80. Number one, the company replaced all the doors in the residential houses with a metallic door at a cost of 96. So they also incurred door replacement costs. An amount of 96. So give me the total adjusted cost. Sorry? 53.04. Good. So now you take the net transfer value, you have the adjusted cost, and that's how you get your capital gain. 33? 23? We have 23.6. So now if you have to get the capital gain tax, just take 15% of 23.90,600. Okay? Sorry? 315.6. Sorry? 358. So you can go and try this question. November 2016, question 3B. November 2016, question 3B. So now let's look at taxation of members club. Yeah, how do we tax members club? For example, a sport club, a golf club, a business club. Yeah, are they taxed? So members club, they are taxed. Also, sometimes they're exempted from taxation also. Yeah, because what happens for the members club is where the members, they pay a subscription fee. Then they contribute some amount. They'll be contributing either on a monthly basis or an annual basis. Now the question is, the amount they contribute, do they just save or do they invest? If they invest, that means they are generating some income. And that income, that means they are carrying on a business. So members club, you're saying that they can be taxed, they can be exempted. When are the members club taxed? Now, members club are taxed only if the income from members, gross income from members is less than 75% of the total gross income. I repeat again, that members club are only taxed if the income from the members is less than 75%. What does that mean? If the income from the members are less than 75%, that means the income from other sources is more than 25%. Yeah, if the income from other sources is greater than 25% of the total income, that one is regarded to be a business going on. What if now the total income from the members was 80%? That means the income from other sources is how much? 20. Now, in this case, they will not be taxed, they'll be exempted. So in short, if the income from the other sources other than from the members is more than 25%, that's a business going on. Less than 25%, that one will be exempted. Good. So now let's go through that. Now, this is a body that allows people to subscribe and often require them to pay a membership fee or subscription. A body of person which carries on a members club shall be deemed to be carrying on a business, and the gross receipt on revenue account, that's including the entrance fee and subscription, shall be deemed to be income from the business. So if it qualifies to be taxed, that means if the income from other sources is more than 25%, even what you have contributed as subscription will be regarded as a normal income. So it will also be taxed. The club shall be taxed if less than 75% of the gross receipt, other than the gross investment receipt, are received from the members, i.e., if the gross receipt from the members are more than 75%, therefore it will not be taxed. Yeah, if the income from the members is more than 75%, that means they'll not be taxed. So I want us to do that question for August 209, question 1B. I just use the one in the notes. Sport Members Club was formed in November 2007, but became operational on 1st of January 2008. For the year ended that 1st of December 2008, the club did not submit income tax return. Why? The club manager argues that Section 21 of the Income Tax Act excludes the club from taxation. Yes, they excluded, but in some condition, that if the income from the members is more than 75%. However, upon being advised by one of the club members to consult a consultant, a tax expert, on the issue, the manager has approached you for further clarification and has provided the following information. Number one, the club received gross income during the year ended that 1st December 2008 amounting to 22 million, which was analyzed as follows. We have the entrance fee, member subscription, interest on late subscription, interest income on fixed deposit account, dividend income, royalty, rent, and then the gain on property transfer. Number two, operating expenses amounted to 4 million. Interest and dividend income was stated gross of tax required. Advise the manager on the taxation status of the club. Your advice should include details on, number one, circumstances under which members club are taxed. Which are the circumstances when members club are taxed? If the income from the members is? Yeah, if the income from the members is less than 75% of the total gross income. Then number two, whether the club is subjected to taxation and the tax liability, if any. So first of all, we need to test whether this club is subject to taxation. And that one, you need to determine the proportion of the income from the members. Income from members. So we are given the schedule of the income for the year. Entrance fee, that's an income from the member. Entrance fee, an amount of 3 million. Member subscription. An amount of 10 million. Interest on late subscription, is it from the members? Yes, good. Interest on late subscription, an amount of 500. Interest income on fixed deposit account, is it from the members? No, that's not from the members. Dividend income? No. Royalty? Rent? Gain on property transfer? So the total income from the members, an amount of 13,500. So now let's explain this one is percentage. So you take 13,500, you divide by the total gross income, which was an amount of 22 times 100%. You got 61.36%. And now the question is the crab subject to taxation? Yes. So the crab is subject to taxation. So therefore, let's determine the taxable income. So this is the year ended. So we have the entrance fee. Amount of 3 million. Member subscription. It will be considered as an income. So therefore will be subjected to taxation, 10 million. Interest on late subscription. Amount of 500. Interest income on fixed deposit. So interest income on fixed deposit account. Amount of 1.6. Dividend income, see that dividend income, they are not taxable. Also, you have royalty. An amount of 1.2. Now, note that this is not a normal business. So we cannot say that these are the operating income. At the business income, then specified sources of income. All of them, they're investment incomes. So there's, you see, this one is not like a normal business like for insurance. That insurance, their key operating income are the premiums. Then in case there is any dividend, becomes a specified source of income. Now these are members club. So that means they can invest in any area they want. So you just factor in all the income. Then there is rent. So that means they had some rented property. Amount of 4. Gain of property transfer. Not taxable, good. Then we raise number 1. Operating expenses amounted to 4 million. So there was operating expenses, an amount of 4. So how much will be now the taxable income? I remember dividend, they are not taxable because the withholding tax is final. Good. 16,300. If you are to get the tax expense, just take 30%. 16,300 to get an amount of. Sorry? 48. Can you open November 2016? Question 2B. November 2016. Question 2B. I told that the following information was extracted from the books of Michezo Sporting Members Club for the year ended that 1st of December 2015. The club manager did not submit income tax return as he argued that the club was exempted from taxation. He has consulted you for professional advice. Additional information. The club received gross income during the year ended that 1st December 2015, amounting to 35 million, which was analyzed as follows. We have the entrance fee. We have member subscription. We have interest on late subscription. Interest income, that's on fixed deposit. We have dividend income, loyalties, rent income, gain on property transfer. Number 2, operating expenses amounted to 360. Interest and dividend income was stated gross of tax. Required. Advise the club manager on the circumstances under which the members club are taxed in your country. Then number 2, assess whether Michezo Sporting Members Club is subject to taxation for the year ended that 1st December 2015 and the applicable tax liability, if any. Can you do it now? Do it now in your books. Yes? Sorry? No, nothing. You don't deduct anything. Eh? Actually, Now let's look at taxation of Saccos. Now, how do we tax Saccos? Yeah, Saccos and cooperatives. So, and notwithstanding any provision of the Act, the total income for the year shall be the aggregate of, number one, 50% of the gross income from interest other than interest from members and FOSA, that's front office savings account. Number two, its gross income from any right granted from the use or occupation of any property, e.g. royalty and rental income. Let me explain. That Sacco, when it comes to taxation, it's a very unique element of taxation. And you're saying that for Saccos, when taxing, we only tax. Okay, Saccos, sometimes they operate like a bank, deposit taking, then they give loan. So that means their major source of income are what? The interest on loan. Now, the interest on loan from the members is not taxable, and that's their major income. They only tax other interest income other than the interest from members and front office savings account. All the other interest, they will be taxed, and not all the amount, only half of it, 50%. And then other income, such as rental income, royalty. So if they don't tax their major income, that's the interest from the members. Another point you need to know that Saccos, they don't have any allowable expense. They cannot even claim for wear and tear. So Saccos have no allowable expenses. Now let's go through that again. Taxation of Saccos. That notwithstanding any provision of the Act, the total income for the year shall be the aggregate of, number one, 50% of the gross income from interest other than the interest from its members and FOSA. Number two, its gross income from any right granted from the use or occupation of any property such as royalty and rent income. The allowable dividend and bonuses for distribution to members shall be restricted at the lower of. Yeah, now the dividend paid to members will be treated as allowable expense. They don't, you see that they don't have any allowable expense, but of the total taxable income, it can be reduced or can be offset against the dividend paid and shall be restricted based on the lower of, number one, 80% of the profit. Then number two, actual dividend and bonuses paid, the lower of the two. And B, Sacco has no allowable or have no allowable deductions. So open with me November 2016. Say that when taxing the Sacco, you tax 50% of the interest income other than the interest from members and FOSA. And then Saccos have no allowable expenses. The only thing that reduces the taxable profit is the dividends, which shall be restricted based on the lower of the actual dividend declared and paid or 80% of the profits. Three A. Jambore Sacco Society Limited reported the following income and expenditure for the year ended that 1st December 2015. So under the incomes, we have gross rental income, interest on savings account, interest on members' loan, interest on fixed deposit account, interest on treasury bills. Expenses, there was repainting of rented property, interest on loan for money invested in treasury bills, admin expenses. You see, admin expense is part of the operating expense. Now that one will be disallowable. Then we have legal expenses relating to the rented property. Additional information. The Sacco declared dividend and bonuses of 980. Corporate tax is at the rate of 30%. Required. The total taxable profit or loss for Sacco for the year ended that 1st December 2017. So this is Jambore. So now let's start with the incomes. Number one, there was gross rental income. Rental income, which is an amount of 840. Then we adjust. Now let's go under the expenses. Under the expenses, number one, we had repainting of rented property. Now that one is not a Sacco expense. So that Sacco have no allowable expense. Now that's an expense that's related to rental or to the rented property. So that one can be offset against the rental income. So an amount of 156. Also, the last expense, legal expenses relating to the rented property, an amount of 72. So how much would be now be the adjusted rental income? 612, 612. The other income we have is interest on savings account. Interest on savings account, an amount of 160, but you only tax half of it, 50%. So 50% is an amount of 80. Then there is interest on members' loan. That is non-taxable. Interest on fixed deposit account, it's an interest income. Interest on fixed deposit account. So take 50% of 560. You get 200 and get 280. Then there is interest on treasury bills. Interest on treasury bills. Take 50% of, how much was the amount? 435 minus. Let's go under the expenses. Now, under the expenses, there was the second one, interest on loan for money invested in the treasury bills. Of these 435 interest earned, we had incurred some expenses, an amount of 114. So first of all, you adjust, then you take 50% of that. Sorry? 160, 500. I think we are done with all the income. So now give me the total. Give me the total. Yes. 1132, 500. Then we raise. Remember, you said that Saccos have no allowable expenses. So in this case, the admin expenses will be disallowable. So you raise the dividends. You raise allowable maximum restricted dividends. And we say that dividend will be restricted based on the row of, number one, the actual dividend paid or declared. Now, how much was that? Note number one. The Sacco declared dividend and bonus an amount of 980. Now, you compare this against 80% of the profit. Now, how much was the profit? 11 that to 500, or the total of the taxable income. 906,000. So it will be restricted based on the row of the two, which is 906. So how much would be the taxable profit? Sorry? 226. Fine. So that means we have to get the tax expense. You take 30% of 226,500. You get 67. And then that was the requirement number two, the tax payable by the Sacco for the year ended that 1st of December 2015. And look at that for 1 minute before we do another illustration. December 2021. Question 2A. And we have 2 Decembers. One is a pilot paper, one was the real paper. So you're doing the real paper, not the pilot paper. Mm. 2B. The following information related to Msanii Sacco Limited for the year ended that 1st of December 2020. We have the income, interest from members' loan, interest from treasury bills, interest from government infrastructure bond. Yeah, is this one taxable? I would say that this is among the untaxed or non-taxable income. Yeah, interest on government infrastructure bond if the maturity period is more than 2 years. Correct. Now this was for 5 years, so that means the interest will not be taxed. Interest from ABA Bank, rental income, dividend from Mazao Sacco, that one won't be taxed. Dividend from Sopa Cooperative Limited, also that one is non-taxable. Then we have the gross income. Then other expenses, there was office expenses, that is disallowable. That for Sacco, all the operating expenses, they are disallowable. General expenses, disallowable. Creditors, disallowable. Repair of rented property. Now, that one is not a Sacco expense. That one should be offset against the rental income. So when I deduct it from the rental income, don't say that I say that there is no allowable expenses. No. We say that the Sacco is the one that does not have any allowable expenses. That's the operating expenses. They don't have any allowable expenses. But this one relates to rented property, so should be offset against the rental income. Additional information. Office expenses include salary to Sacco employees, disallowable. Salary to the caretaker of rented property. Now that one should be offset against the rental income. Purchase of office computers, that's disallowable. General expense include depreciation of 484 and non-performing loans to members of 620, which were written off. So that's relevant. Whether it's written off, whether it's depreciation, for Saccos, there is no allowable expenses. All of them will be treated as the same. Corporate tax rate during the year was 25%. Required. Adjusted taxable profit or loss. How do we get that? Adjusted taxable profit or loss. So this is Msanii. So we have the interest. We have the incomes. Now for the income, we have interest from members' loan. Is it taxable or non-taxable? Non-taxable. Interest from treasury bills. That is taxable. but only 50% of it. You take 50 is, we'll come back to hint, yeah? Yes. 50% of that you get an amount of? Yeah, 1,600. Interest from government infrastructure bond, that is non-taxable. Interest from ABA bank. Interest from ABA bank. So take 50% of 1,500, you get an amount of 750. Then we have rental income. Rental income is an amount of that too. Then you raise. Now let's go to the expenditure. And the expenditure, the last item we have is repair of rented property, an amount of 1,300. Then additional information number 1. So that office expenses include their salary to caretaker of rented property, 200. So you minus 1,500, you get an amount of 1,700. Dividend from Mazao, not taxable. Dividend from SOPA, not taxable. So give me the total income. You get an amount of 40, 50. They never declared any dividend. So that means this one becomes the taxable profit. Now let's go back to the required. Go back to the required. Adjusted taxable profit or loss for the year that 1st December 2020. Hint. Start with the reported profits. So what if now we start with the reported profit? It was a complete record. Yeah, but you see that for this specialized transaction, it's not a must. If you're given complete record, you start with the net profit. You can just take the taxable income and then you raise the expenses. So in this case, you are given the hint. Now let's use the hint. So Msanii. Now I want us to see whether if you use the you start with the net profit, will you still get the same amount? So for the year ended 31st of December 2020. So we start with the reported profit or the net profit. Net profit was an amount of 19,140. Then you add back what? Good. So you add back disallowable expenses. Let's go to the expenditure. Expenditure, we had office expenses. Note number 1. Office expenses include salary to Sacco employees. So that one is disallowable. Salary to Sacco employees. Amount of 1,200. Salary to the caretaker of rented property. That one is to be offset against the rental income. Then there was purchase of office computers. An amount of 400. What about other office expenses? So let's go back to the expenditure. And the expenditure, we had office expenses, which was an amount of how much? It was an amount of 50. Then you raise what we have already adjusted in note number 1. Now, note number 1, you are told that office expenses include. So you eliminate everything in that. Salary to the Sacco employees amount 1,200. Also included the salary to caretaker of rented property. That one is to be offset against the rental income. You still eliminated 200, as well as purchase of office computer amount of. So how much was other office expenses? 40? 3800. Then under expenditure, you also had general expenses. an amount of 1,400. That one requires no adjustment, because you have been told that note number 2, office general expenses include depreciation. Even depreciation, in this case, we have said that Sacco has no allowable expenses. Whether it's a depreciation, whether it's wear and tear, still will be disallowable. So you add it back. Credit loss, bad debt. Bad debt is a disallowable expense. You add an amount of 60. Repair of rented properties. That one is allowable expenses, but to be offset against the rental income. Good. So you add back disallowable expenses, then you raise non-taxable incomes. You see, of this reported profit, they had included all the income, but some of this income, they are not taxable. So you eliminate them. Number 1, we have interest from members' loan. An amount of 16,200, you eliminate it. Interest on treasury bills. Is that one untaxable? Yes. You see, we did that you only tax 50%. So that means the other 50% is not what? Not taxable. Good. 50% of that 200, it will get an amount of 16. Interest from government infrastructure bond. Amount of 1,800. Interest from ABA Bank. With an amount of 1,500, of which 50 is taxable. So the other 50% is non-taxable. So 50%, an amount of 750. Rental income, that is taxable. Dividend from Azao Sacco. Amount of 1,000. And then dividend from SOPA Cooperative. Amount of 600. Give me the taxable profit. Get an amount of 40. So if now you are to get the tax expense, you take 25% of 40/50. 20/25 divided by 2, you get 10, 12.5. That's simple as that. Yes. No, you'll not get, because the question is very clear. You are given a hint. Start with what? Good. If there is no hint, you can use any. Actually, that will be the best one. Yeah. Yes, you still get the 4 marks. Yes, provided you have attained the objective of determining the taxable profit. Yes. Good. So now, at the back of your notes, the last element we have in that. So first of all, let's discuss what we have there. We have taxation of trade association. Let's go through that. That a trade association may choose by notice in writing to the commissioner in respect of the year of income to be deemed to be carrying on a business charged to tax, whereupon the gross receipt on the revenue account from the transaction with its member, including the entrance fee and annual subscription, and any other person shall be deemed to be income from business for that and succeeding year of income. And that's the provision as per section 21 of the income tax. It's extracted. Yeah, most of the trade association, they are treated like a member scrap. But in this case, there is no provision of 75%. Yeah. And then there is taxation of unit trusts. We'll go through that. Then lastly, there is taxation of ARIs. Have we done that one? Yes, we did that one in class. This one, we did it before. Yeah, so we have already done that. So you're done with that handout. So in our next session, still proceed with business income. Now, the major two we are remaining with is taxation of hire purchase entity. So that one has been introduced in the syllabus. Also taxation of leasing entity. Now, once we are done with that, we'll be done with the business income. Now we look at other issues such as back duty and tax investigation. Good. Any question? I think I'm done for today. So you can call it a day. And then I always request that have the notes in advance. For taxation, I don't dictate.